Welcome to Power Books, the channel where we break down the most powerful books on success, wealth, mindset, trading, and investing to help you achieve financial freedom and mastery. In today's video, we're diving into The Disciplined Trader by Mark Douglas, a must-read for anyone looking to develop the mental discipline and emotional control needed for long-term success in trading and investing. If you're ready to unlock game-changing insights that can transform the way you think and operate in the markets, stick around until the end. Don't forget to like, subscribe, and hit the notification bell so you never miss out on powerful knowledge. Now let's get started. Part 1. The Road to Success. Chapter 1. Why a New Thinking Method is Necessary. In this opening chapter, Mark Douglas explains why most traders fail and why success in trading requires a completely different mindset than what people are used to. He emphasizes that the biggest obstacle to success isn't the market, it's the trader's own psychology and emotions. Key concepts. 1. The traditional way of thinking doesn't work in trading. Most people are conditioned to think in terms of certainty and control, but the market doesn't work that way. Traditional decision-making relies on logic, rules, and predictability, which don't apply to trading. In trading, success comes from adapting to uncertainty, not trying to eliminate it. Traders must learn to think differently, to accept uncertainty and focus on probabilities. 2. Why most traders struggle. Most traders enter the market with unrealistic expectations, believing they can predict price movements. When trades go against them, they experience fear, frustration, and self-doubt, leading to impulsive decisions. Losses feel personal, and traders often react emotionally rather than rationally. Successful traders don't try to predict the market. They react objectively to what it gives them. 3. The psychological barriers to success. Douglas explains that the biggest obstacles to profitability are not technical skills, but mental and emotional habits, such as fear of losing money makes traders exit too early or avoid taking good trades. Overconfidence after wins leads to reckless risk-taking and overtrading. Revenge trading, trying to make back losses quickly, resulting in bigger mistakes. Lack of patience, failing to wait for the right trade setup. A trader's greatest enemy is their own mind. Controlling emotions is the key to consistency. 4. The need for a new thinking method. To succeed, traders must rewire their thinking to embrace uncertainty rather than fear it. Trading is a probability game, and one loss or win doesn't define long-term success. A disciplined trader follows their edge consistently, knowing that profitability comes from execution, not prediction. The market rewards discipline and patience, not emotions and impulsive decisions. Key takeaways from Chapter 1. The biggest obstacle in trading is not the market, it's the trader's psychology. Traditional thinking methods don't work in trading. Uncertainty must be embraced. Fear, greed, and impatience lead to bad decisions and inconsistency. Thinking in probabilities and managing emotions are the foundation of trading success. Chapter 2. The nature of the trading environment from a psychological perspective. In this chapter, Mark Douglas explains how the trading environment is completely different from any other profession and why traders must develop a unique mindset to succeed. He highlights the psychological challenges traders face and how they can overcome them. When the market has no structure or rules like traditional jobs, most careers follow a structured path. You work hard, follow rules, and get rewarded. Trading, however, is an unstructured environment where success depends on your ability to adapt to uncertainty. There are no guarantees, no fixed salary, and no external rules forcing discipline. Traders must create their own structure and discipline to succeed. 2. The freedom of trading is a double-edged sword. In trading, you can do whatever you want. There are no bosses, no deadlines, and no one stopping you from making reckless decisions. This level of freedom can be dangerous because traders often act on impulse, emotions, or greed. Unlike a normal job, there are no immediate consequences for bad habits, making it easy to repeat mistakes. With great freedom comes great responsibility. Self-discipline is essential. 3. The market does not provide instant feedback like other professions. In most jobs, mistakes lead to immediate consequences, teaching people to correct their behavior. In trading, a bad decision can still result in a winning trade, reinforcing bad habits. Similarly, a good decision can still lead to a losing trade, making traders question their strategy. Traders must focus on long-term probabilities rather than individual trade outcomes. 4. Emotional reactions to market movements. The market is constantly changing, triggering fear, greed, hope, and frustration in traders. Many traders become emotionally attached to their trades, leading to revenge trading, hesitation, or overconfidence. To succeed, traders must train themselves to remain emotionally neutral and execute their plan consistently. Emotions are a trader's worst enemy. Discipline and objectivity are key. Key takeaways from Chapter 2. Trading is an unstructured environment. Success depends on self-discipline. The freedom in trading can lead to reckless behavior if not controlled. Mistakes don't always have immediate consequences, making it easy to develop bad habits. Traders must detach emotionally from the market and focus on probabilities. Chapter 3. The market's perspective. In this chapter, Mark Douglas shifts the focus from the trader to the market itself. He explains how the market operates in a way that is completely indifferent to individual traders and why understanding this is crucial for success. Key concepts. 1. The market is neutral and unbiased. The market doesn't care about you, your trades, or your emotions. It exists as a reflection of collective buying and selling decisions made by millions of participants. Price movements are simply the result of traders acting on their beliefs and emotions. Understanding that the market is neutral helps traders detach emotionally from their trades. 2. The market is a constantly changing flow of opportunities. No two trading days are exactly alike. The market is always evolving. Patterns may repeat, but they don't guarantee the same outcome every time. Traders who try to force the market into a rigid, predictable model set themselves up for failure. Successful traders adapt to market conditions rather than trying to control them. 3. The market is a probability game, not a certainty game. Many traders struggle because they want certainty. They look for the perfect strategy or guaranteed setups. However, the market is driven by probabilities, not certainties. Even the best trade setups can fail, and even bad setups can succeed. Traders must shift their mindset from being right to managing risk and probabilities. 4. Why traders struggle to accept the market's nature. Most people are conditioned to seek control over their environment. In life, following rules generally leads to predictable rewards, but in trading, no rule guarantees success. Traders often resist the market's randomness, trying to force their expectations onto price action. The key to success is accepting the market's uncertainty and learning to operate within it. Key takeaways from Chapter 3. The market is neutral. It doesn't care about your trades or emotions. The market is always changing. Rigid thinking leads to failure. Trading is about probabilities, not certainties. No strategy works 100% of the time. Success comes from adapting to the market, not trying to control it. Chapter 4. The Trader's Perspective. In this chapter, Mark Douglas explores how a trader's beliefs, emotions, and biases shape their market experience. He explains why traders often struggle with fear, overconfidence, and irrational decision-making, and how shifting to the right perspective can lead to consistent success. Key concepts. 1. Traders view the market through their own beliefs. Every trader sees the market differently based on past experiences, biases, and expectations. Some traders see opportunities, while others see risks, even when looking at the same chart. This personal perspective creates emotional reactions, making it hard to stay objective. To succeed, traders must detach from personal biases and see the market for what it is, not what they want it to be. 2. How fear and hope affect trading decisions. Fear of losing makes traders hesitate, close trades too early, or avoid opportunities. Hope makes traders ignore warning signs, hold losing trades too long, or risk too much. Both emotions cause inconsistent decision-making, leading to frustration and losses. Traders must develop emotional discipline to follow their strategy, regardless of fear or hope. 3. Why traders struggle to accept losses. Most people are conditioned to avoid failure, but losses are a natural part of trading. Many traders take losses personally, feeling like they made a mistake or that the market is against them. Instead of accepting losses as part of the game, they try to make back money, leading to revenge trading. Successful traders accept losses as part of the process and move on without emotional attachment. 4. The illusion of control in trading. In life, effort and hard work usually lead to success, but in trading, effort doesn't guarantee profits. Many traders try to force control by overanalyzing, adding more indicators, or looking for certainty. The market is unpredictable. Control comes from managing risk, not predicting outcomes. The only thing traders can control is their own actions. Risk management and discipline are key. Key takeaways from Chapter 4. Your beliefs shape your trading experience. Objectivity is crucial. Fear and hope cause emotional trading. Discipline removes inconsistency. Losses are part of trading. Accept them without emotional attachment. You can't control the market, only your actions. Focus on managing risk. Chapter 5. Thinking in Probabilities. In this chapter, Mark Douglas introduces one of the most critical mindsets for successful trading: thinking in probabilities. He explains why traders must abandon the need for certainty and instead focus on executing a consistent edge over time. Key concepts. 1. The market is a probability game, not a certainty game. Many traders struggle because they expect certainty. They want a strategy that wins all the time. But the market is unpredictable, and even the best strategies only work over a series of trades, not every single trade. Trading is like a casino. Casinos don't win every game, but they win over time because they have an edge. Success in trading comes from consistently applying an edge, not from winning every trade. 2. Every trade is unique, but patterns repeat over time. No two trades are exactly the same. Market conditions, emotions, and order flow always change. However, traders can identify repeatable patterns that provide a statistical edge. Even if a trade setup looks perfect, there's still a chance it could fail. Winning traders focus on the bigger picture and don't get attached to individual trades. 3. The key to consistent profitability: thinking like a casino. A casino doesn't care about individual bets. It knows that over thousands of hands, its small edge will make it profitable. Traders must adopt the same mindset. Execute trades with an edge, a system with positive expectancy. Risk small on each trade to survive the randomness of individual outcomes. Trust the long-term process instead of reacting emotionally to short-term results. A single trade doesn't matter. What matters is consistency over hundreds of trades. 4. Detaching emotionally from individual trades. Many traders celebrate wins and feel devastated by losses. This emotional attachment leads to inconsistency. Instead, traders should see trades as just another execution of their edge, not a personal victory or failure. By thinking in probabilities, traders free themselves from emotional swings and trade with confidence. Detach from individual trades and focus on executing a strategy with discipline. Key takeaways from Chapter 5. Trading is about probabilities, not certainties. No strategy wins 100% of the time. Every trade is unique, but patterns repeat over time. Consistency is key. Think like a casino. Focus on your edge over a large sample of trades. Detach from emotions. Winning and losing are just part of the probability game. Part 2. The nature of trading. Chapter 6. The impact of beliefs on trading. In this chapter, Mark Douglas explains how our beliefs shape our trading decisions, often in ways we don't realize. He explores why traders struggle with emotional reactions, irrational decisions, and inconsistent results, all of which stem from their deeply ingrained mental programming. Key concepts. 1. Beliefs shape perception and decision-making. Every trader brings a set of beliefs about money, success, risk, and probability into the market. These beliefs filter how we see market information. Two traders looking at the same chart can interpret it completely differently. Many traders struggle because their beliefs about the market are not aligned with its reality. To trade successfully, traders must examine and reshape their beliefs about the market. 2. How negative beliefs create emotional trading. If a trader believes, "I must win every trade to be successful," they will experience fear and anxiety with every loss. If a trader believes, "The market is out to get me," they will feel frustration and revenge trading tendencies. Many limiting beliefs come from past experiences with money, success, and failure, not from the market itself. By identifying and changing limiting beliefs, traders can eliminate emotional reactions. 3. The market is a mirror of your beliefs. The market itself is neutral. It doesn't create fear, greed, or hesitation. Instead, it reflects what you believe. If you are afraid of losing, the market will trigger that fear. The only way to change your market experience is to change your beliefs about trading, risk, and success. Trading success starts with mastering your mindset, not just your strategy. 4. Reprogramming your mind for trading success. The key to consistency is aligning your beliefs with the realities of the market. This requires letting go of perfectionism. Losses are part of trading. Accepting uncertainty. No trade is guaranteed to win. Developing confidence in probabilities instead of emotions. Traders must train their minds to think objectively and let go of limiting beliefs. Key takeaways from Chapter 6. Your beliefs shape how you see the market. Change your beliefs to change your results. Fear, greed, and hesitation come from negative beliefs, not the market itself. The market is a mirror. What you feel comes from your mindset, not price action. Reprogramming your beliefs leads to discipline, consistency, and success. Chapter 7. How emotions influence trading decisions. In this chapter, Mark Douglas explains how emotions like fear, greed, and frustration impact a trader's ability to make rational decisions. He reveals why traders often struggle with hesitation, impulsiveness, and revenge trading, problems that stem from their emotional attachment to money and the outcome of trades. Key concepts. 1. Trading triggers deep emotional responses. The market is an uncertain environment, and uncertainty creates fear and anxiety in most traders. Winning makes traders feel overconfident and reckless, while losing triggers fear, hesitation, and revenge trading. Most traders fail because they let emotions dictate their actions instead of following a disciplined plan. The market doesn't create emotions. Your response to uncertainty does. 2. Fear, the number one emotion that sabotages traders. Fear of losing causes traders to hesitate to enter a trade, missing good opportunities. Exit trades too early, cutting profits short. Avoid taking trades altogether, leading to frustration. Fear is rooted in a trader's belief system. If you associate losses with failure, every trade becomes emotionally stressful. To overcome fear, traders must accept that losses are a natural part of the game. 3. Greed and overconfidence, the trap of winning streaks. After winning several trades, many traders feel invincible and start taking reckless risks. This leads to over-leveraging, over-trading, and ignoring their strategy, eventually resulting in big losses. Greed makes traders hold on to winning trades too long, hoping for more profit, only to see the market reverse. The key to long-term success is managing emotions, not chasing profits. 4. Revenge trading, emotional reactions to losses. After a losing trade, many traders feel the need to get back at the market by taking impulsive trades. This often leads to bigger losses, creating a cycle of frustration and emotional instability. Successful traders accept losses objectively instead of taking them personally. A disciplined trader follows their plan, regardless of emotional highs and lows. 5. Developing emotional mastery in trading. The best traders have emotional control. They stick to their system no matter how they feel. To master emotions, traders must detach from individual trades. Each trade is just one of many. Trust the process. Consistency is more important than short-term results. Create rules and follow them. Self-discipline removes emotional decision-making. Emotional stability is the foundation of trading success. Key takeaways from Chapter 7. Fear makes traders hesitate, exit early, or avoid trades. Accepting losses reduces fear. Greed leads to reckless trading. Stick to your risk management rules. Revenge trading is emotional, not logical. Detach from losses and stay disciplined. Successful traders control their emotions, while losing traders let emotions control them. Chapter 8. The Dynamics of a Losing Trade. In this chapter, Mark Douglas breaks down the psychological process of a losing trade and how it affects traders emotionally and mentally. He explains why most traders react poorly to losses, making irrational decisions that lead to a cycle of self-destruction. The key to breaking this cycle is understanding that losses are normal and part of the probability game. Concepts. 1. The emotional roller coaster of a losing trade. A typical trader goes through a predictable sequence of emotions during a losing trade. The problem isn't the loss, it's the trader's emotional reaction to the loss. 2. How traders turn small losses into big losses. A losing trade is not dangerous. What makes it dangerous is how a trader reacts to it. Many traders refuse to take small losses, hoping the market will turn in their favor. This leads to holding on to losing trades for too long, causing massive account damage. A professional trader cuts losses quickly and moves on to the next trade. 3. Why traders struggle to accept losses. Society conditions us to avoid failure at all costs. Traders see a loss as a personal failure instead of a normal part of trading. This mindset leads to fear of losing, which then causes hesitation, emotional trading, and inconsistency. A successful trader treats losses as business expenses, not personal failures. 4. Breaking the cycle, how to handle losing trades properly. The key to overcoming the emotional impact of a loss is to change your perspective. Accept that losing is part of winning. Every trading system has losses. Follow a stop-loss strategy. Never let one trade destroy your account. Detach from outcomes. Focus on executing your edge, not individual trade results. Think in probabilities. No single trade matters. Success comes from consistency over time. Losses don't define you. Your ability to manage them does. Key takeaways from Chapter 8. The emotional reaction to a losing trade is what causes bigger problems, not the loss itself. Refusing to accept a loss leads to bigger losses. Cut losses quickly and move on. Losses are part of the trading game. Learn to accept them objectively. Think in probabilities. Don't focus on individual trades. Focus on long-term consistency. Chapter 9. The Dynamics of a Winning Trade. In this chapter, Mark Douglas explores the psychological challenges traders face when managing a winning trade. While losing trades trigger fear and denial, winning trades often bring greed, overconfidence, and premature exits. Douglas explains why traders struggle to let their winners run and how emotions can sabotage potential profits. Concepts. 1. The emotional roller coaster of a winning trade. A typical trader experiences a cycle of emotions when a trade starts winning. The problem isn't the winning trade, it's the trader's emotional response to it. 2. Why traders exit winning trades too soon. Many traders struggle with letting profits run because of deep-seated psychological fears. Fear of the market reversing and turning a winner into a loser. Fear of being wrong, exiting too soon gives a sense of control. Desire for certainty, locking in small profits feels safe. Paradoxically, traders often cut winning trades short while holding on to losing trades too long, the exact opposite of what they should do. Successful traders trust their plan and allow winners to develop. 3. The danger of overconfidence after a winning trade. A series of winning trades can make traders feel invincible. This often leads to increasing position size, taking impulsive trades, or ignoring risk management. Overconfidence after a win can be just as dangerous as fear after a loss. Every trade is independent. Don't let past wins influence future decisions. 4. How to manage winning trades like a professional. To avoid emotional mistakes, traders must follow a clear exit strategy, use trailing stops or a profit target. Detach from money, view trading as probabilities, not cash value. Accept uncertainty. No trade will move perfectly in your favor. Think long term. Winning on a single trade isn't the goal. Consistent profitability is. The best traders don't just know when to enter, they know when and how to exit. Key takeaways from Chapter 9. Winning trades create emotions just like losing trades. Both can lead to bad decisions. Fear causes traders to exit too soon, while greed makes them hold on too long. Overconfidence after a win can lead to reckless risk-taking. Professional traders let winners run and stick to their strategy. Chapter 10. The impact of market beliefs on trading behavior. In this chapter, Mark Douglas explains how a trader's beliefs about the market shape their trading behavior, often in ways they don't realize. The way traders interpret price action, react to wins and losses, and make decisions is deeply influenced by their subconscious market beliefs. Douglas emphasizes that success comes from aligning your beliefs with the realities of the market. Key concepts. 1. How beliefs shape trading decisions. Every trader has a unique set of beliefs about the market, risk, and probability. These beliefs determine how traders perceive price action, how they handle risk and losses, whether they follow or ignore their strategy. If beliefs are inaccurate or limiting, traders will struggle even with a great strategy. To change trading results, traders must first change their market beliefs. 2 common market beliefs that sabotage traders. Many traders enter the market with beliefs that work against them, such as, "The market is out to get me," leads to paranoia and revenge trading. "I have to be right to make money," causes fear of losing and hesitation. "If I win a few trades, I have the market figured out," leads to overconfidence and reckless risk-taking. "Losses mean I'm a failure," creates emotional stress and fear-based decisions. Successful traders reprogram these beliefs to align with market realities. 3. The market is neutral. Only your mind creates meaning. The market has no agenda. It doesn't care about your trades. Price moves up and down based on probabilities and collective actions, not personal vendettas. Traders who take losses personally become emotional and irrational. A disciplined trader views the market objectively without attaching emotions to outcomes. 4. How to reprogram your market beliefs. Accept randomness. No trade is guaranteed to win. Think in probabilities. Focus on the bigger picture, not single trades. Detach from emotions. Don't let past results influence future decisions. Align beliefs with reality. The market is neutral. Success comes from executing a solid strategy. Your trading behavior is a reflection of your beliefs. Change your beliefs, and you change your results. Key takeaways from Chapter 10. Your beliefs about the market determine your trading behavior. Negative or false beliefs create hesitation, fear, and inconsistency. The market is neutral. Traders must stop personalizing losses. Success comes from aligning beliefs with the real nature of trading. Chapter 11. The Trader's Reality. In this chapter, Mark Douglas discusses the harsh realities of trading and why most traders fail to adapt to them. He emphasizes that the market operates in an environment of uncertainty and probability, which is very different from how people are conditioned to think. To become successful, traders must shift their mindset to accept this reality and adapt accordingly. Key concepts. 1. The market does not provide certainty. Most traders want certainty. They want to know exactly when and where the market will move. However, the market is built on probabilities, not guarantees. Traders who seek certainty often hesitate, doubt themselves, or chase trades out of fear. The market is unpredictable. Success comes from managing risk, not predicting movements perfectly. 2. Why traditional thinking fails in trading. Society teaches people to seek security, guarantees, and being right. Trading, however, requires embracing risk, uncertainty, and probabilities. Most traders lose because they apply traditional success principles, such as avoiding failure at all costs, to an environment that requires accepting losses as part of the game. Trading success is not about avoiding losses, it's about managing them properly. 3. Every trade is just one of many. Losing traders focus too much on the outcome of individual trades. Professional traders see each trade as part of a larger probability model. No single trade matters. What matters is following the strategy over a long series of trades. Detach from the outcome of individual trades and focus on long-term consistency. 4. Traders must create their own structure. Unlike a traditional job, trading has no boss to enforce discipline, no fixed schedule or rules, no guaranteed income. This means traders must set their own rules, follow their trading plan without external pressure, control their emotions and avoid impulsive decisions. Trading requires self-discipline. No one will hold you accountable except yourself. Key takeaways from Chapter 11. The market operates on probabilities, not certainty. Traditional thinking, seeking security, avoiding failure, does not work in trading. Each trade is just one of many. Focus on the big picture. Traders must be self-disciplined and create their own structure for success. Part 3. Building the foundation for success. Chapter 12. Understanding the source of trading errors. In this chapter, Mark Douglas explains that most trading errors don't come from a lack of knowledge or strategy, but from deep-rooted psychological issues. These errors are often driven by fear, misaligned beliefs, and emotional reactions, causing traders to act irrationally despite knowing better. To succeed, traders must understand and address the true source of their mistakes. Key concept. 1. Trading errors are psychological, not technical. Most traders believe they fail because they lack a better strategy or more indicators. In reality, they make mistakes because of psychological biases and emotional responses. Common trading errors include entering trades too early or too late, cutting winners short out of fear, holding on to losing trades hoping for a reversal, overtrading due to frustration or revenge. The problem isn't the market or strategy, it's how traders react emotionally. 2. The role of fear in trading mistakes. Fear is the main cause of most trading errors, and it comes in different forms. Fear of losing causes hesitation or closing trades too soon. Fear of missing out, FOMO, leads to chasing trades impulsively. Fear of being wrong stops traders from admitting losses and exiting bad trades. Fear-based trading leads to inconsistent decisions and missed opportunities. 3. The subconscious mind controls trading behavior. Many trading errors come from unconscious beliefs about money, risk, and failure. If a trader has negative associations with loss, they will resist accepting small losses, leading to bigger drawdowns. Past experiences with failure, rejection, or financial insecurity can unknowingly affect how traders handle risk. To change trading results, traders must first change their subconscious programming. 4. How to overcome trading errors. To eliminate self-sabotaging behaviors, traders must identify and challenge their limiting beliefs about trading and money. Reframe losses as part of the probability game, not personal failures. Develop self-awareness to recognize when emotions are influencing decisions. Follow a structured trading plan to avoid impulsive actions. Mastering trading psychology is more important than mastering technical analysis. Key takeaways from Chapter 12. Most trading errors come from emotional and psychological weaknesses, not lack of strategy. Fear is the biggest cause of bad trading decisions. Fear of loss, fear of missing out, and fear of being wrong. A trader's subconscious beliefs about money and risk control their actions more than they realize. The key to fixing trading mistakes is developing self-awareness, discipline, and a strong mindset. Chapter 13, Overcoming Fear and Emotional Resistance. In this chapter, Mark Douglas explains that fear is the biggest obstacle to consistent trading success. Fear-based decisions lead to hesitation, cutting winners short, holding on to losing trades, and impulsive actions. To trade effectively, traders must reprogram their mindset and develop emotional resilience to handle uncertainty with confidence. 1. Fear is the root of trading failure. Fear manifests in different ways, such as fear of losing money causes hesitation and early exits. Fear of being wrong leads to revenge trading and emotional decisions. Fear of missing out, FOMO, results in chasing bad trades. Fear of uncertainty prevents traders from executing their strategy with confidence. Trading success requires embracing uncertainty rather than fearing it. 2. How emotional resistance affects trading. Many traders resist change because their subconscious mind is wired for comfort and security. This resistance creates self-sabotage, making traders repeat the same mistakes. Emotional resistance is why traders keep using bad strategies, avoid learning from mistakes, struggle to trust their edge in the market. Breaking free from emotional resistance requires self-awareness and a willingness to change. 3. How to overcome fear in trading. To conquer fear and emotional resistance, traders must reframe losses. See losses as part of the game, not personal failures. Accept uncertainty. Stop trying to control or predict every move. Follow a process. Trust a well-defined strategy instead of trading based on emotions. Detach emotionally from money. Think in probabilities rather than focusing on individual wins or losses. Rewire your mindset. Use affirmations, visualization, and self-reflection to replace fear with confidence. Fear doesn't disappear completely, but disciplined traders learn to manage it. Key takeaways from Chapter 13. Fear is the biggest reason traders fail. It leads to hesitation, impulsive actions, and self-sabotage. Emotional resistance keeps traders stuck in bad habits and prevents growth. Success comes from accepting uncertainty, following a process, and detaching emotions from money. Traders must actively reprogram their mindset to replace fear with confidence. Chapter 14, Developing the Proper Mental Discipline. In this chapter, Mark Douglas explains that mental discipline is the key to consistent trading success. Most traders fail not because of a lack of technical knowledge, but because they cannot control their emotions and stick to a structured approach. Developing mental discipline means training yourself to follow a plan, execute trades without hesitation, and detach emotionally from market outcomes. Key concepts. 1. Trading requires a unique type of discipline. Unlike traditional jobs, trading has no structure, no boss, and no guaranteed paycheck. Traders must create their own structure and enforce their own discipline. The market will not reward good behavior or punish bad behavior immediately, making it easy to develop bad habits. Mental discipline means following your rules even when it's uncomfortable or inconvenient. 2. Why most traders lack discipline. Impulsive behavior. Traders get tempted to enter or exit trades based on emotions instead of logic. Overconfidence. After a few wins, traders take unnecessary risks, ignoring their strategy. Revenge trading. A losing streak triggers emotional decision-making rather than controlled execution. Hesitation. Fear of being wrong prevents traders from taking valid setups. Successful traders execute their plan consistently, regardless of emotions. How to develop mental discipline in trading. To build the proper mindset, traders must commit to a trading plan, define clear rules and stick to them. Detach from individual trades. View trading as a probability game, not a single event outcome. Control impulses. Avoid making decisions based on fear, greed, or frustration. Develop a routine. Have a structured process for market analysis, execution, and review. Practice patience and self-control. Accept that not trading is sometimes the best trade. Mental discipline is built through repetition, self-awareness, and a strong commitment to process over outcome. Key takeaways from Chapter 14. Trading success comes from mental discipline, not just technical knowledge. Lack of discipline leads to impulsive trading, hesitation, and inconsistency. To succeed, traders must create their own structure and follow a strict process. Discipline is developed through patience, self-control, and emotional detachment from trades. Part 4. Becoming a disciplined trader. Chapter 15. Adapting to changing market conditions. In this chapter, Mark Douglas emphasizes that markets are constantly changing, and traders who fail to adapt will struggle to remain profitable. Successful traders develop the mental flexibility to adjust their strategies and expectations based on evolving market conditions. Rather than rigidly sticking to a single approach, disciplined traders learn to recognize shifts in market behavior and respond accordingly. Key concepts. 1. The market is always changing. No market condition lasts forever. Trends reverse, volatility shifts, and new patterns emerge. Many traders struggle because they assume what worked in the past will always work in the future. Those who fail to adapt often get caught in stagnation, frustration, and large drawdowns. The best traders embrace change and adjust their approach when necessary. 2. Why most traders struggle to adapt. Overconfidence in a strategy. Traders stick to what worked before, even when it stops working. Emotional attachment to past success. Winning trades create false confidence, leading traders to ignore new market conditions. Fear of uncertainty. Many traders resist change because it creates discomfort. Inability to recognize shifting dynamics. Traders get too focused on past trends instead of analyzing the present market structure. Traders must remain flexible and open-minded to recognize when their strategy needs adjustments. 3. How to adapt to market changes effectively. To stay ahead of changing markets, traders must recognize market shifts early, pay attention to changes in trend strength, volatility, and price behavior. Develop a versatile strategy. Have multiple approaches for different conditions, e.g. trending versus ranging markets. Detach emotionally from past trades. Avoid assuming that because something worked before, it will always work. Remain open to learning. Continuously refine skills, backtest new ideas, and adapt to emerging market patterns. Accept uncertainty. The market is not fixed, it evolves, and traders must evolve with it. Trading is a game of adaptation. Rigidity leads to failure, while flexibility leads to long-term success. Key takeaways from Chapter 15. Markets are always changing. Traders must adapt to stay profitable. Many traders struggle to adapt due to overconfidence, emotional attachment, and fear of uncertainty. Success requires recognizing market shifts, adjusting strategies, and remaining flexible. The best traders continuously learn and refine their approach based on changing conditions. Chapter 16. Managing Risk and Uncertainty. In this chapter, Mark Douglas highlights that trading is a game of probabilities, not certainties. No trade setup is guaranteed to win, and the key to long-term success is learning how to manage risk effectively while embracing the uncertainty of the markets. Many traders fail because they try to eliminate uncertainty rather than learning to operate within it. Key concepts. 1. Risk is an inherent part of trading. The market is unpredictable. No matter how much analysis is done, any trade can lose. Many traders struggle because they seek certainty rather than focusing on risk control. Accepting risk removes emotional attachment to outcomes and allows traders to execute without fear. Successful traders don't avoid risk, they manage it wisely. 2. Why most traders struggle with risk management. Over-leveraging. Traders risk too much on a single trade, leading to large losses. Inconsistent position sizing. Some trades are over-risked while others are under-risked. Ignoring stop losses. Traders hold on to losing trades hoping for a reversal. Fear of missing out, FOMO, leads to impulsive trades without proper risk assessment. Risk management is the foundation of trading longevity. Without it, even the best strategy will fail. 3. How to manage risk and uncertainty effectively. To become a disciplined trader, you must Define risk per trade. Risk a fixed percentage, e.g. 1% of your account on every trade. Use stop-loss orders. Never enter a trade without a predefined exit plan. Think in probabilities. Focus on executing a strategy with an edge rather than trying to predict the market. Avoid emotional decision-making. Follow a consistent risk management plan, even after a losing streak. Accept uncertainty. Understand that losing trades are part of the game and do not define success. Traders who master risk management can survive drawdowns and thrive in the long run. Key takeaways from Chapter 16. Risk is a natural part of trading. Trying to eliminate it leads to failure. Poor risk management, over-leveraging, ignoring stop losses is a major reason traders blow accounts. The best traders focus on probability, consistent position sizing, and emotion-free execution. Managing risk ensures long-term survival in the markets, even when uncertainty is high. Chapter 17, The Trader's Edge, Developing a Winning Strategy. In this chapter, Mark Douglas explains that trading success is not about predicting the market. It's about having an edge and executing it consistently. An edge is a statistical advantage that, when applied over many trades, leads to profitability. However, many traders fail because they focus on finding the perfect strategy instead of mastering execution and discipline. Key concepts. 1. What is a trader's edge? A trader's edge is a strategy with a positive expectancy, meaning that over many trades, it produces more profits than losses. Having an edge doesn't mean winning every trade. It means that over time, the probabilities work in your favor. The key to success is consistently applying the edge without hesitation or emotional interference. Trading is a probability game. A winning strategy works over the long run, not in every single trade. 2. Why most traders struggle to develop an edge. Chasing holy grail systems, many traders jump from one strategy to another, seeking perfection. Lack of consistency. Some traders have an edge but fail to execute it properly. Emotional interference. Fear and greed prevent traders from following their system. No risk control. Even a strong edge can fail if risk management is ignored. A good strategy is only as effective as the trader's ability to execute it with discipline. 3. How to develop and execute a winning strategy. To gain a true edge, traders must define clear entry and exit rules, remove subjectivity, and create repeatable setups. Think in probabilities. Accept that some trades will lose and focus on the long-term results. Stick to the strategy. Follow the plan without second-guessing or making emotional decisions. Combine strategy with risk management. Even the best strategy will fail without proper position sizing and stop-loss use. Track and review performance. Keep a journal to analyze what works and refine the approach. The best traders don't have the perfect strategy. They have a solid edge and the discipline to execute it. Key takeaways from Chapter 17. A trader's edge is a strategy with a positive expectancy over many trades. Most traders fail because they lack consistency, discipline, and risk control. Success comes from applying the strategy with discipline, not predicting individual trade outcomes. A well-defined edge combined with risk management leads to long-term profitability. Chapter 18. The Steps to Becoming a Disciplined Trader. In the final chapter, Mark Douglas outlines the key steps to becoming a disciplined and successful trader. He emphasizes that trading is not just about technical knowledge, but about mastering one's mindset, emotions, and behavior. The path to consistent profitability requires a structured approach, self-awareness, and a strong commitment to personal development. Key concepts. 1. Trading discipline is a learned skill. Discipline is not something traders are born with. It must be developed through practice and commitment. Many traders fail because they let emotions override logic, leading to inconsistent execution. The market does not reward effort, it rewards objectivity, patience, and consistency. Discipline separates professional traders from amateurs. 2. The steps to becoming a disciplined trader. To achieve success, traders must follow a structured process. Step 1. Define a clear trading plan. Establish specific rules for entries, exits, and risk management. Step 2. Develop self-awareness. Recognize emotional triggers that lead to impulsive or fearful decisions. Step 3. Accept losses as part of the process. Losing trades are inevitable. Focus on executing consistently. Step 4. Detach from individual trades. Think in probabilities and avoid emotional attachment to outcomes. Step 5. Follow a routine. Create a daily process for market analysis, trade execution, and performance review. Step 6. Build confidence through consistency. Trust the system and apply it without second-guessing. Step 7. Keep a trading journal. Track decisions, emotions, and mistakes to improve over time. The more disciplined a trader becomes, the more consistent their results will be. 3. The ultimate goal. Trading with a calm and objective mindset. A disciplined trader remains unaffected by wins or losses, focusing solely on execution. Emotions like fear, greed, and frustration no longer control decisions. Confidence comes not from winning trades, but from trusting the process and following the plan. When discipline becomes a habit, trading success follows naturally. Key takeaways from Chapter 18. Discipline is the foundation of trading success and must be developed intentionally. Following a structured plan, managing emotions, and thinking in probabilities lead to consistency. The best traders detach emotionally from trades and focus on execution, not outcomes. Mastering discipline allows traders to navigate uncertainty and achieve long-term profitability. Chapter 19. The Power of Self-Trust and Confidence. In this final chapter, Mark Douglas emphasizes that self-trust and confidence are the ultimate keys to long-term trading success. Many traders fail not because of a lack of knowledge, but because they doubt themselves, hesitate, or let fear and emotions control their decisions. To become a disciplined and consistently profitable trader, you must develop unwavering trust in yourself and your trading process. Concepts. 1. Self-trust is essential for consistency. The best traders execute their strategy without hesitation because they fully trust their edge. Many traders struggle because they lack confidence and second-guess their trades, leading to inconsistency. True confidence doesn't come from winning trades. It comes from following the process regardless of the outcome. Confidence is built through discipline and repeated execution of a proven strategy. 2. Why most traders struggle with confidence. Fear of losing. Traders hesitate or avoid taking trades due to past losses. Emotional attachment to outcomes. They judge success by individual trades instead of the long-term process. Inconsistent execution. They fail to stick to their plan, which erodes self-trust. Seeking external validation. They rely on others' opinions instead of trusting their own analysis. Confidence comes from within, not from wins, external opinions, or temporary results. 3. How to build self-trust and confidence in trading. To develop strong confidence, traders must follow the trading plan religiously. Consistency builds trust in your system and abilities. Detach emotionally from individual trades. Focus on probabilities, not single trade results. Review and learn from mistakes. Keeping a journal helps reinforce trust in the process. Trade with a clear and focused mindset. Eliminate distractions and external influences. Reinforce positive behavior. Reward yourself for executing correctly, not just for winning trades. The more you trust yourself and your process, the more confident and successful you'll become. 4. The ultimate mindset of a disciplined trader. A confident trader accepts uncertainty and executes without hesitation. They trust their plan and decisions, regardless of short-term outcomes. Fear, greed, and doubt no longer control their actions. They operate with logic and discipline. When self-trust and confidence become second nature, trading success follows effortlessly. Key takeaways from Chapter 19. Confidence in trading comes from trusting yourself and your process, not from short-term results. Hesitation, fear, and doubt are caused by a lack of self-trust and inconsistent execution. The best traders focus on probabilities, not emotions, and remain confident even after losses. Building self-trust leads to unwavering confidence, discipline, and long-term profitability. Chapter 20. Achieving consistency in trading. In the final chapter, Mark Douglas explains that consistency is the ultimate goal of every successful trader. While many traders chase profits, true success comes from executing a strategy with discipline, confidence, and emotional control. Achieving consistency requires mastering both the technical and psychological aspects of trading.
Key concepts.
1. What does consistency mean in trading? Consistency doesn't mean winning every trade. It means executing the strategy the same way every time. Profitable traders understand that trading is a game of probabilities and trust their edge. The key is to follow a structured process and eliminate impulsive decision-making. The market rewards consistency, not randomness. 2. Why most traders struggle to be consistent. Lack of a clear trading plan. Many traders enter trades based on emotions rather than predefined rules. Emotional reactions, fear of loss, greed, and revenge trading lead to impulsive actions. Inability to accept uncertainty. Traders want certainty, but the market is inherently unpredictable. Failure to follow risk management, over-leveraging, and poor position sizing create instability. Consistency comes from discipline, patience, and emotional control. 3 steps to achieving consistency in trading. To become a consistent trader, follow these steps. Step 1. Commit to a proven strategy. Choose a strategy and master it without constantly switching. Step 2. Follow a fixed risk management plan. Keep risk per trade consistent, e.g. 1% of capital. Step 3. Maintain emotional control. Accept wins and losses as part of the game. Step 4. Track every trade. Keep a journal to identify patterns and improve execution. Step 5. Focus on process, not profits. Success comes from executing the plan correctly, not individual trade outcomes. The best traders don't trade emotionally, they trade systematically. 4. The mindset of a consistently profitable trader. They are patient and disciplined, sticking to their strategy. They don't get emotionally attached to wins or losses. They think in probabilities and don't fear losing trades. They have a long-term perspective, focusing on execution rather than short-term results. Consistency is the result of mastering both the technical and psychological aspects of trading. Key takeaways from Chapter 20. Consistency in trading means executing your plan with discipline, not winning every trade. Traders fail due to emotional reactions, lack of risk management, and strategy hopping. To be consistent, follow a structured plan, control emotions, and think in probabilities. Profitable trading is a process, not a prediction game. Consistency is the key to long-term success. That wraps up our summary of The Disciplined Trader by Mark Douglas. If you found this video valuable, make sure to like, subscribe, and hit the notification bell so you never miss out on more powerful book summaries on success, trading, investing, and mindset. Drop a comment and let me know your biggest takeaway from this book. I'd love to hear your thoughts. Thanks for watching, and I'll see you in the next video. Keep learning, keep growing, and keep winning.